Our methodology is focused on the premise that investors tend to underestimate how long growth companies can continue their growth path. And we spent the last 20 years trying to perfect and understand the factors that distinguish one successful growth company from one that is not likely to sustain the growth rate. We found that a set of 8 factors, which we call Oberweis octagon, tend to be indicative of companies that are likely to continue to succeed. And we start by looking for companies that are experiencing strong financial performance, but there has to be qualitative barriers to entry that would allow the company to continue the growth rates. So some of the things might be a patent, or it could be a unique technology. It might also be a special market position, like, for example, the leading #1 market position in a niche market that's in a high growth area. Those are the types of things that we look at. Take Baidu as an example. Baidu entered the Chinese marketplace with the #1 market position, challenged only by really Google. That was quite different, I think, in terms of ability to operate within the Chinese marketplace, both from an understanding of the local culture as well as the political relationships to keep things intact. If you think about Green Mountain, it also highlights a part of our process. We like to buy companies that can expand margins if they're successful over time. The thing about Green Mountain, the key to their brand is a company that they own called Keurig. Keurig makes a single cup coffee brewing system, and the strong part for Keurig is being able to get the brewers into enough homes to be able to get critical mass, so that it's very difficult for other companies to come in. They have a patented system that patent has been enforced and tested in court, and they've won and collect royalties. So as they get brewers into houses, companies want to create coffee that will run on their system. As more and more companies create coffee and more brewers are in people's homes, it creates a huge barrier to entry. And eventually, Keurig effectively becomes a company that sits around and collects royalties and really doesn't have to do anything. We love companies that collect royalties and do nothing, with huge barriers to entry and very strong increasing profit margins over time. Hansen, they were being valued like a beverage market without a brand. We thought that the alternative beverage market was a rapid growth industry, and it was being played out in Hansen Financial. We saw a company growing at 30 or 40%, despite the fact that the PE at that time was really only 10, 12 times earnings. We also saw an opportunity to consolidate and garner market share in what had historically been a fragmented industry with very limited brand potential. That's another thing that we look for in our companies. We look for companies that are emerging in high growth industries, that are consolidating brands to become the dominant player. That's exactly what Hansen was doing, and yet the stock valuation wasn't reflecting any of those things at the time. When we're investing in high growth companies, we come in hoping to be married forever. We hope to own the shares for the next 10 or 15 years. Unfortunately for growth companies, usually things change, and at times there are fundamental issues that will drive us out of a stock. Let's start with a few indications. First of all, we see financial performance deteriorate, and that really focuses us in on the company to understand that they're losing their competitive advantage. We'll also look qualitatively, though, to see other competitors emerging that perhaps we hadn't anticipated that might drive away the competitive advantage. The hard one is valuation. What about if a company is so successful that they become widely appreciated on Wall Street, such that the valuation might reduce the future potential? So when we look at those situations, it's very tricky, because sometimes stocks that look expensive on a PE basis are expensive because their true earnings are actually going to come in higher than analysts estimate, and the market is beginning to discount that fact. We have to separate those from companies where there's just an over-exuberant investment community. We think that in many cases, the street tends to underestimate the growth potential and the barriers to entry for highly successful growth companies. On the other hand, if we do the math and we put in our most optimistic estimates into what a company might earn, and still come out to the stocks overvalued, that might lead us to sell shares. To be specific, it's something like a Green Mountain Coffee or an Open Table or a Hansen Natural or Baidu. There are folks who called those stocks overvalued for years, after which they doubled, tripled, and quadrupled. So we're very much focused on operating leverage of the business when we're trying to figure out when to sell a company.